Howdy there, folks. Welcome into today's video. It's a buy one, get one free, a 2-for-1 here today. Two videos to react to. First one is a top Apple analyst is projecting that Apple's in some major trouble in 2023. So we're going to go through kind of what they're talking about there, hear them out, and I'll react to that and kind of give my opinion there. Second video I want to react to here is this one. A lot of two-way risk is in the market right now, says Morgan Stanley's Mike Wilson, which is interesting because that's basically, talking about, and we'll get into the nitty gritty and the details there. But when you think about two-way risk, you think about major risk for bulls and bears, which is very interesting because usually in the market, it's only like a major risk to one side or the other. So yeah, I hope you guys enjoy this as always. Thank you everybody that subscribe to the channel. I appreciate each and every one of you that always enjoy the reaction videos. And if you got an opinion on anything in today's video, let me know in the comment section. Appreciate y'all. And let's get into this.
Here, TFI International Securities, okay? Widely followed analyst there says shipments will be 15 to 20 million units less than expected with significant downside risks. We're talking about the 14 and the 14 Pro.
15 to 20 million miss in terms of units. Run the numbers on that. Let's just say an average, an ASP of $1,000 or $1,100. Oh boy, okay. We're talking about billions and billions and billions of dollars of of difference there. Wow.
We've gotten headlines like
Pro
this.
and the Pro Max.
And the Pro Max, thank you. Yeah. So what do we know about this? I mean, TFI International Securities.
Well, he's independent now, actually. He's formerly, but yes.
Formerly,
yeah. So okay. Ming-Chin Kuo,
formerly known as.
He is the killer Apple analyst. He's really good at, or probably the best in my opinion. I always pay attention to what he says because he predicts what Apple's going to do like a year in advance before they actually do it.
Okay, so this is legit. When this analyst says it, he's plugged in.
Yes.
What do we make of this?
Especially to the supply chain. He's based in Taiwan. So
what do we make of it?
So this is important, okay? And we're about to get into details here. You have some analysts that are like, I don't know what's going on. Okay. And then you got other analysts that are actually, know what they're doing, okay? So when this particular analyst has an opinion on something, when they're telling you something's going to happen, it's likely going to happen, okay? And so let's get in the nitty gritty here. But, I just think it's worth mentioning because, yeah, you have some analysts that are just clueless around stocks and some that are really the top. This is like top tier analysts around Apple stock.
His forecasts are much lower. I'm reading the entire Medium post that he posted on this right now. He's predicting 70 to 75 million total handsets. Now, keep in mind, when this quarter started, Scott, most analysts were predicting 90 million handsets for Apple, which would have been flat, but they were counting on these Pros kind of making up for the revenue because the Pros are actually in higher demand than the regular 14, so they have that higher selling price, and that's what people were really banking on, and Apple was banking on to meet its revenue growth targets for the quarter. Now, if this is true, and it's, way below that 90 million. Plus, you can't just walk into a store and get an iPhone. You can't get one in time for Christmas even. So it looks like he's also saying he doesn't think it will go into January. The demand, if people can't get it in time for Christmas,
wow,
they're not going to try it in January, which would be interesting and unique for the Apple customer.
It sounds surprising to somebody like you who covers this company closer than anybody else?
Well, not surprising in the context of what we saw coming, those pictures we saw coming out of China last week. We still don't really know the full impact of those protests yet, right? We know that it's halted production. We know the initial shutdown slowed things down, and Apple had to give that warning several weeks ago. And then we had these protests, which apparently are making things worse. Now, look, I've been asking Apple every day about this. What's the latest? What's the latest? What's the latest? We haven't heard anything from Apple since last Wednesday evening when they said, look, we got people on the ground in Foxconn. We're monitoring the situation, but no update to its statement a few weeks ago when they said, look, the iPhone, we're going to sell fewer of these phones than we thought. That's all they've said so far.
Maybe they haven't said much because
I've been trying to warn people about this, right? I own a stock named Wynn Resorts, right? Which has, 3 massive resorts in Macau, right? Which is kind of like a region that kind of is China and it's kind of its own thing. It's a complicated relationship nonetheless. But I've just watched how they've been kind of like strung along for almost 3 years now in terms of like, oh, we're going to open back up Macau. And then it's like, oh, not really. And then like, oh, we can't really let people visit. And like, and I've just watched that, right? And so I'm seeing this whole Apple situation, right? And I just felt like as soon as they announced they were closing down that assembly facility, right? The Foxconn one, the massive one. Then right away I was kind of like, we'll see if that just opens back up, right? And we'll see how that all works out because at the end of the day, like when it comes to like China, they haven't been stable. They haven't been predictable. They haven't really been helpful. And I know they always had tried to roll out the red carpet for Apple specifically, but I'm still just very wary. Let's call it that. Very wary of what the situation is going to be kind of moving forward there. And I wouldn't get too excited if I was an Apple shareholder about things magically being fixed or something like that.
No, I mean, it sounds like it's so fluid, right, with everything that, you get these kinds of forecasts. They're not exactly sure what the numbers are. But Josh, Barclays today is kind of in line with what we're hearing from Kovac in this new report from this influential analyst. They expect 15 million shortfall, increasingly a risk for downside to 20 million shortfall. So we're talking about similar numbers, at least on the headline. But as you heard Steve say, under the surface, it sounds potentially much worse.
I guess my question for you would be, here are two questions.
Yeah.
The first is Apple has been very deliberately trying to downplay the meaningfulness of how many phones they're selling in any particular quarter.
They've done that for years now.
They've done that for years now. Whether or not we all, as the Wall Street community, decide to go along with that is a different question. But assuming that's the case, and Apple can steer the conversation toward, look, we will eventually sell these units, just might not get sold in December, maybe January, February. How much impact historically has something like that really had on the stock? I would argue not much. Number two, how much are we already discounting this? Apple is underperforming the S&P 500, down 18% versus 16%. Historically, it doesn't do that in a bad tape. Apple's usually one of those names that holds up better. So aren't we already pricing in some of this volatility in shipments when we look at where the stock is year to date?
And we saw that move yesterday, right? When it was down 2.5%. What's it down now? About 1.5%. So it might already be priced in now. So when we get these results, at the end of January, it won't be as much of a surprise potentially.
I think that's historically been like the right case.
So what do we do with this, Steph? There's also a note from Wolf Research today on the technicals, which suggests that Apple looks poised to revisit the key 135 support level. I bring all this up because we're having conversations every day about where's this rally, right? Where's the end of the year rally that you keep hearing predictions about? Oh, it's going to arrive, seasonality, don't worry about it. Santa Claus is going to show up. If Apple...
Wait a minute. Hold up. First thing is, we already had a rally. I don't know if anybody missed that one, but we already had a rally, okay? And the rally started way before a lot of the Wall Streeters thought. A lot of the Wall Streeters thought we were going to get like an end of November into December rally. What happened in reality is the stock market bottomed the morning of October 13th. And from there, we had a very, very nice rally. So we got kind of a Santa Claus rally just early this year. And so I just think that's something important. It's like we can't just like look past the fact that we kind of had a rally already, folks.
Test some technical levels around 135 if it even breaches that level. Where's that rally going?
Yeah, I mean, we can slosh around for a bit, right? We've been in a trading range all year long.
Well, I'm talking about for the last 5 weeks of the year. We're going to slosh around more?
I still think we could kind of trend higher, but I don't see new highs by any means. So it's like 4,200 on the upside, maybe 39 on the downside. I think we trade in a range.
New highs? What do you think? I wasn't talking about going to 4,800 stuff in the next 5 weeks.
I'm saying trading range. We could rally between now and the end of the year, but it's probably capped at about 4,200 on the upside, and on the downside is about 3,900, and that's because of this whole inflation problem and Fed problem. So that's not going away anytime soon. And I was very encouraged, by the way, of the Case-Shiller numbers today, falling for the third consecutive month. That's really good news. And CPIs and PPIs are rolling over, certainly, but inflation on an absolute basis remains very, very high. So that's why
don't worry, you're going to see a lot more months of those numbers down. A lot more months.
We're going to be in a trading range. Now, to Apple, it's 7%.
The biggest question is, are we going to see multiple years of down numbers? That's the only question in my mind.
S&P 500. I'm 1% weighted in this name in one portfolio out of 3 that I run. And I haven't been excited about Apple because they have issues. It's not just China, though, Steve, right? I mean, this is a timing issue. This is a supply issue versus a demand issue.
Right.
We know there is demand, so I think people will look through it. What I have a problem with is it's a stay-at-home beneficiary.
Yeah, so she brings up a good point. Stay-at-home beneficiary, they absolutely were in a massive, massive way. They're also just a froth in the market, stimulus money, businesses feeling good. They benefited from all that as much as anybody. We'll never know the direct money that made it to Apple's pockets, right? I think the new Apple Watch is likely selling very well, but for the new Apple Watch, The numbers are so small compared to the iPhone business. That's a problem. The iPhone business is so massive that if you're talking about a 15 to 20 million iPhone, miss, it's horrible. And now Apple's already into their fiscal 2023. So now this is going to make their entire fiscal year look really, really bad, right? And the other way I kind of look at this is if they think magically every iPhone that, let's say, they couldn't have sold this past quarter is going to be sold in the next quarter, I don't know. Because here's the issue. The consumer, right? The consumer is not in a good place. And they might have blown through their last bit of money over this holiday season for, let's call it the masses. And so that's something to be concerned about. That is something to take into consideration, right? And if somebody blows through their money and then they don't have the money to buy that new Pro, so they don't get the new Pro or whatever it's called, iPhone. So I just think that's something to take into context in regards to that, okay? Next one up here, a lot of two-way risk in the market right now, warns Morgan Stanley's Mike Wilson.
Morgan Stanley's chief U.S. equity strategist and CIO. Mike, it's always good to see you.
Thanks for having me.
Two-way risk sounds so like markets up, markets down. What do you mean by that?
Well, it's not getting any easier. Okay, let's put it that way. I mean, I think the first half of this year is, fairly simple if you just were bearish and kind of held that position. And then, we've had two major, tactical rallies since June, the first one, and then, of course, one in October. This one actually has better breadth, which is kind of interesting. And so I do think we're closer to the end. We don't know when the Fed's going to pause. We think it's January. I think they do 50 in December, 25 in January, and that's it. Okay, that's ahead of where the market is. And the market's trying to pre-trade that, kind of like it did this summer. Now, we thought it was premature this summer to get in front of that. This time, we actually think there's validity to that. The question is, what are you going to pay for this thing if you think earnings are going to be really disappointing next year, which is our core view? So, we're trying to have our cake and eat it too. We like to do that, right? So we're having a tactical rally now. I kind of agree with Steve. We probably got some upward bias into year end. But ultimately, the bear market's not over, and we got significantly lower lows if our earnings forecast is correct.
Yeah, so 2023, your price target.
Did you hear what he just said? That is a key word. He said significantly lower lows. That's interesting. Significantly lower lows.
Out 3,600 is your bear case, 3,900 is the base, and 4,200 is the bull case. What's the rate expectation backdrop to these cases?
Yeah, so it's probably somewhere between 275.3 if it's a recession to maybe 4.25 if there's a reacceleration in the back half of the year. I'd probably split the difference. I'd probably say it's 3.25, something like that. Look, to me, it's not about the year-end targets. It's about the path. Right? Nobody cares about what's going to happen in 12 months. They need to deal with the next.
By the way, just so you know, his base case is basically right around where the S&P's trading at right now, which is intriguing.
Is 6 months. And that's where we actually think there's significant downside. So while 3,900 sounds like, that sounds like a really boring 6 month. No, this is going to be challenging.
It's a wild ride.
It's going to be a wild ride. And there's going to be a lot to do. I say the best thing I can say is, the breadth's getting better. The average stock is doing better than the index. And there's going to be probably stock opportunities going forward as opposed to just trading the index.
I think it was October 14th on a Friday is when you came out tactically bullish, 15% rally. It's exactly what happened. So you nailed that. But 3,600 as a bear case does not seem catastrophic to me, given the backdrop that we've talked about for a while. So I guess what are your earnings number? Then what multiple?
Rumor is he watched my October 13th video about epic rally coming, and then he jumped on the bullish side. Just kidding.
And on the back of that.
Yeah, but remember, 3,600 is year end 2023. So our bear case path is 3,000. So, and look, the range we've given people is you should expect a S&P between 3,000 and 3,300 sometime in probably the first 4 months of the year. That's when we think the deceleration on the revisions on the earnings side will kind of reach its crescendo.
I'm sorry to interrupt. 3,000 to 3,300.
That's extremely bearish. No doubt about that. That was a major, major drop. You're talking about a lot of the big tech stocks, falling another 20, 30% from here or so, which is very appealing to long-term shareholders or long-term investors. That sounds pretty darn attractive. If that does happen, you can't jump too in front of that stuff and get too excited. But nonetheless, that would be a lot of pain ahead for a lot of stocks that haven't really been hit that hard. A lot of these, Dow stocks, for instance, man, would you see damage. Man, would you see damage. That's where a lot of the losses would come. Oil and gas stocks, a lot of those would get wrecked. A lot of people have been in this pipe dream of oil and gas stocks are going to do great in the recession. No.
In the first 4 months of the year, in which case? In any case?
That's the range. We can't be that precise.
Right. But still.
Yeah, that's a big drop.
That's a big drop.
Correct.
Yeah. Okay.
And that will be driven really by the earnings revisions to the downside, which is the second half of our thesis for this year, which is the ICE part of the fire and ice.
So, Mike, you mentioned that the average stock is doing better than the index. And what have we seen? We saw the 5 largest stocks in the S&P 500 and the NASDAQ all guide down for the current quarter, right? And so they've acted pretty poorly. It's Microsoft, Apple, Google, Amazon, Tesla. So do you think there's risk, the fact that the market rally has broadened out this time compared to the one in the summer?
That's got to hurt Dan to even throw Tesla into that same sentence. That's got to hurt him, man.
But this is not going to be a one-quarter phenomenon. You're just saying you're expecting revisions, downside revisions in estimates to speed up here. Does that really cause a flush in a way? If the major names lead to the down...
If you didn't know and if you weren't aware, okay, just for some backstory on this gentleman in Tesla, he's always very much hated Tesla stock, and he's definitely, I think he borderline despises Elon Musk, and the way he speaks about Elon countless times, I'm like, wow. Talk about somebody that really, really hates Elon Musk. It's this man right here. He does not like him.
And then weak hands and some of that other breath starts coming out. We could get to your 3,300 pretty quickly in the new year.
That's right. I mean, look, we think most of the damage will happen in these bigger companies, not just tech, by the way. It could be consumer, it could be industrial.
Yep,
remember,
it will be.
When those stocks had a tough time in October, the money went into these other areas. So part of that, rally has been driven just by repositioning from the money moving. That doesn't mean it's safe. Okay, so I want to be perfectly clear. We're still pretty bearish on the next 6 months. It's our job to call these tactical rallies. We got this one right. We don't always do that. I still think this tactical rally has legs into year end, notwithstanding all the noise we're going to get in the next 2 weeks, simply because of the liquidity at year end and people chasing, and we have to deal with that. So this is not a time to sell everything and run for the hills, because that's probably not until the earnings come down in January, February.
Well, it's interesting, Sue, but you do seem like you're saying by March or April or May of next year, the bottom is in.
I think so.
And what tells you the bottom is in? Is it the revision story, or is it really the combination of the Fed has signaled?
So there's really two things, Tim. I mean, I think you have to really take a view on. The first is, okay, first, are we going to get those revisions? Are you going to get price to give you a fat pitch? Because that's the one thing that hasn't happened yet this year. Even though June, prices got low, and October they got low, the equity risk premium never really came in, right? It was all about rates. Now you need the equity risk premium to kind of blow out to tell you that there's a recession risk or a real earnings, degradation. But to get bullish, you then have to take a view, okay, are we in a 70s stagflation type scenario, which you're not going to get bullish? Or are you in the 1940s boom bust scenario that we've been kind of talking about, where there's a bust next year in earnings, but then 24, there's actually a reacceleration in earnings. Okay, and that's our core view. So the market will figure that out, we think, sometime in the spring, maybe early summer, and there'll be a good second half.
Mike, thank you for coming by. Good to see you. Mike Wilson, Morgan Stanley.
So that's a potential, but what needs to happen if we're going to see 2024 earnings go up is we'll have to have a situation essentially where we get a recession, but it's not a massive recession, right? And if we were to get a colossal recession where we're talking about millions of jobs being lost, where we're talking about the construction industry dry up, massive amounts of jobs being lost in the manufacturing field and things like that, then we would probably in that scenario not bottom until 2024. And then in terms of earnings really picking up in any substantial way, it probably wouldn't be till 2025 in that situation, okay? So do keep in mind, a lot of this, and it's so hard to predict, but a lot of this is going to be dependent upon if we're talking about a massive deceleration in the economy and in terms of job loss and things like that. It really depends on how deep we're talking, because we haven't really even seen that yet. And if we get that, and that's a big if, and we get it in a major way, then we're talking about we're not bottoming until 2024 at that point in time. If we're talking about just an easy, a little like 4.5% type unemployment, 5%, something like that, yeah, we'll bottom in 23. But if we're talking about it's going to be an epic recession, then we're talking about 2024 bottom. So that's just something to kind of keep in mind there for all investors out there, right? And none of us can predict how, deep or bad things will get. So as a long-term investor, all you can do is buy companies that you love for the long term in 2023 and just play that game, right? And so anyways, appreciate y'all joining me as always. Much love. Thank you everybody that subscribed to the channel and enjoys these reactions, and a lot more coming. Much love and have a great day.